Hi, this is Roy Walker with a quick overview, an easy explainer on the COVID-19 impact on the economy and stock markets. I'm going to go through very quickly, just a quick overview. Obviously, background, we've got the pandemic, coronavirus, that spreads easily through droplets via breathing, contact with hands, transfer for mouth and eyes. A big issue is that people who are infected can infect others even though they themselves may not be showing symptoms. So big contrast to the SARS outbreak in Asia a few years ago, where you could travel around, they'd have heat sensitive cameras at airports and be able to pick out people who might be infected. That doesn't work here. People can travel around. We've got no way of knowing who's infected and who isn't. So we're all now familiar with the phrase flattening the curve. Just to underline the importance, flattening the curve means slowing the infection rate so that the health resources can keep up. Obviously, if everyone gets infected all at the same time, there's a massive need for intensive care intervention, and that load just puts an unbearable strain on the healthcare infrastructure and healthcare workers. In the background, we've got the race for a vaccine. And a reminder, in general, you can't cure viruses. There are plenty of viruses out there in society that there are no cure for. We can only treat symptoms and let the body's immune system fight the infection. Vaccines can be difficult or indeed impossible to create. And one of the reasons there's some optimism for COVID-19 is its similarity to the flu, being also a coronavirus. But vaccines take time to develop, and even once developed, there has to be, importantly, fully testing before it can be deployed, because even if there is one tiny negative side effect, if it's being deployed to billions of people, that's going to be an issue. So although there's optimism, most experts are saying we still might be at least a year away from a deployable vaccine for COVID-19. So what happened? We saw a stock market peak February 19th. A little more than a month later, prices are down about a third. I'm looking here at the S&P 500, the index of the largest 500 firms in the US. So mega corporations, and between those 500 firms, they count for about 1/3 of the market capitalization of listed companies around the world globally. Reason for the plunge, it's uncertainty, investor panic. COVID-19 is pretty scary stuff. Okay, let's look at some practical effects of the measures against coronavirus. Obviously, we're familiar with hand sanitizing, face masks, social distancing, but businesses, big problem. Shuttered businesses, restrictions on firms' operation, population curfews, quarantines, lockdown, travel bans. The net result of all this, business activity has taken a massive hit, and this is shown by the Purchasing Managers Index, which is a leading indicator and has traditionally been reliably indicating previous plunges in GDP. So we look the last month, the latest PMI figure plunged drastically harder and faster than that during the global financial crisis. This chart was created a few days before the latest GDP numbers that have just come out, which are almost -5. So if this chart was redrawn today, there'd be a grey bar there just to show that the indicator did indeed show the GDP falling off a cliff the last 3 months. Okay, if businesses can't open or they're shuttered, their solvency and survival is under threat. What do you do if you run a business? You cut staff salaries, you lay off people, you keep people on the sidelines, you furlough them if necessary. So it's no surprise that we've seen a huge surge in new unemployment, new jobless people in the United States. And in fact, difficult to believe, the unemployment rate right now is probably greater than 20% in the United States. So the last 2 weeks of March, 10 million people made new claims as jobless, and in the first 4 weeks of April, another 20 million made claims. This is an absolutely enormous, cataclysmic rise in the unemployment situation, the employment situation in the United States. People are losing their job, no surprise, consumer confidence takes a beating. So the Michigan Consumer Sentiment Index, been running for decades, is also a good, reliable indicator, leading indicator of the future course of the national economy. And that index plunged again off a cliff. So down for April, down to 71.8. The month before, 89.1. This is a chilling warning. Consumer sentiment, how the consumer, the man in the street, the families, how they feel about their personal situation is a warning to take to be aware of. Okay, if people aren't feeling that great about their own personal circumstances, it's pretty obvious consumer spending follows suit. Consumer spending, also economists call it PCE, personal consumption expenditures, is the value of goods and services purchased by US residents. So for the last 3 months, December, January and February, modest gains each month, but March, PCE, consumer spending, fell off a cliff, negative 7.5%. There we are. So there is month 2, 2020, so February. There's month 3, 2020, so March. 7.5% reduction in consumer spending in the United States. And there we can see it illustrated in a slightly different way. Okay, so consumer spending falling off a cliff. Why is that important? Because consumer spending represents about 70% of US GDP, gross domestic product. So if consumer spending is fallen like this, it's absolutely no surprise that when the data came out this week, that we've seen GDP itself, the official published data, negative 4.8% for the first quarter of 2020. Negative growth basically means the economy has contracted by 4.8% in the last 3 months. And since World War II, there have only been 8 worse quarters in terms of a plummet in one quarter of that number. Another way of looking at it, here we are. Ideally, the economy, we want it to grow in that 2% range where we can create jobs and avoid the problematic inflation. Here is the global financial crisis. Here's what's happened to GDP in the last 3 months, the first 3 months of 2020. Okay, but hold on a second. All right, so we've seen GDP plummet through the fall, but remember this chart? Okay, so that negative 4.8 was for the first quarter, January, February, March. Okay, but the surge in jobless didn't start until halfway through March. So it looks like only the last 2 weeks of March has created this massive issue in terms of the fall in GDP. Okay, negative 4.8 for Q1. Q2 now has started in April, and we don't even know what those numbers are, but we've got twice as many, another 20 million unemployed just the first 4 weeks of April. What on earth will the GDP numbers hold for Q2 2020? I don't think we need a crystal ball to be able to answer that question. Okay, let's just look at some of the detail. How have stock prices been affected? So the stock market, remember, is basically a forecasting machine. Okay, so based on data that we know and based on analyst forecasts of company earnings and market sentiment, the price of a company's shares instantaneously at any time represents collectively the investors, the market's consensus on the value of firms. So known data is straightforward, but the analyst forecasts depend on assumptions about the future. And a big input to analyst forecasts is the corporate earnings guidance. Now, corporate earnings guidance, every quarter when companies publish their the earnings figures, traditionally it's common for many companies to give guidance about what they think the future holds. Now, when those assumptions are problematic, that can cause negativity about the forecasts. Worse, if firms pull out from issuing guidance, those analyst forecasts are basically becoming guesswork. If the companies, if corporations themselves aren't giving much away about what they see for the future, then how on earth are the industry professionals, the analysts, investors supposed to make sense about what the future holds for stocks? Meanwhile, even on the current consensus earning forecast, forward PE for the S&P 500 suggests that right now, given market prices and the consensus earnings, share prices are high by historical standards. Okay, so let's just say what actually is happening to earning guidance. Well, since March, so just in the last few weeks, over 500 corporations in the US have removed or suspended quarterly or annual earnings guidance, and 86 of those, as of right now, are S&P 500 companies. FedEx, 17th of March, great uncertainty caused by the coronavirus pandemic. Equifax, 20th of April, continued uncertainties resulting from the economic impact. Coca-Cola, 21st of April, given the great uncertainty, we feel it's prudent to hold off providing fiscal guidance. Kimberly-Clark, 22nd of April, due to the rapidly evolving situation, high degree of uncertainty. AT&T, 22nd of April, due to the lack of visibility relating to the pandemic and recovery. And American Express, 22nd of April. It's impossible to forecast our financial results for the rest of the year, this is good phraseology, without knowing the answer to the two questions: when and how quickly the economy improves, and what happens to unemployment and the pace of small business recovery. Okay, so what on earth is going on with the stock market then? Stocks, since that peak in March, stocks have staged a relief rally, almost 1/3 up from that trough. Why? Continual drip. First of all, monetary measures from the Federal Reserve, massive liquidity support to businesses. The US government's fiscal stimuluses, the coronavirus relief measures, combined totaling trillions so far. And of course, we've got a stream of news items, positive news items about drug treatments, vaccine research, and to be honest, markets are going up because markets are going up. There's FOMO, fear of missing out. Some investors just want to ride that momentum. Okay, let's have a note of caution. Does the Fed support really help? Well, the crisis is about economic activity, not about liquidity. It doesn't matter how cheap your loans are. If you can't open your front door and you're not getting the footfall traffic, you ain't got a business to run. The government fiscal stimulus does sound big, but not necessarily compared to the size of the domestic economy. How many more relief packages are going to be needed? And let's remember that known data, you know, the Q1 GDP still doesn't include what we've seen, another 20 million unemployment due to the surge in April. Okay, so let's wrap it all up. Why have we got reasons for pessimism? We've got an almost 5% drop in GDP in Q1, and that's without that full brunt of April's unemployment rise. We've got business activity falling through the floor. We've got consumer confidence falling through the floor. Both of those are proven leading indicators about what's next for the economy. We've got uncertainty about when businesses will get back to work and how quickly that will pull through to unemployment. We've got corporations unwilling to forecast the future. Is that because they just don't know, or is it because they suspect but they just don't want to say? Price earnings ratios look high. Stocks look highly priced based on historic levels and given the forward earnings. There's talk of possibility of second wave of infections if restrictions come off too early. And of course, the last few days, Trump versus China, part 2. He's talking about maybe some financial penalties for China in view of really as a way to punish them for the way he says that they didn't do enough to stop the virus spreading throughout the rest of the world. Reasons for optimism: the huge liquidity support from the Fed and the massive stimulus from the US, of course. Yeah, and more will be forthcoming. The curves are peaking, so the curves are flattening. We are at the top in many parts of the world, including the US, and parts of the US. We're seeing the curves peaking for the infection and the death rate, and because of that, we're now seeing plans for easing the lockdown and easing business restrictions. We've seen positive news on drug trials for treatment. Let's just stress that's treatment. The one that's in the news the last couple of days, yes, it has improved recovery rates by a few days, but that's not the same thing as a vaccine. We cannot rely on herd immunity. We need a vaccine to be able to be mass deployed around the globe. And of course, ultimately, ingenuity, science, self-belief of mankind. So, my opinion, not financial advice. In my opinion, markets have been looking past 2020. They've been really focusing on the growth on the upside into 2021, and in my opinion, probably overemphasizing the snippets of news relating to virus treatments, vaccine developments, peak rates, prospects for relaxing lockdown restrictions. And I would say they've perhaps paid less attention than they should do to actual facts, and the facts on the ground, the indicators relating to unemployment, consumer sentiment, consumer spending, business activities, all of those kind of areas. Because let's face it, what happens during the rest of this year and beyond, it's all about the consumer. It's consumer spending, it's unemployment. That's going to dictate how the economy will fare for the rest of this year. Of course, optimism, in the long run, things will always get better. We will get to that point where we'll see the recovery come. But right now, the warning signs are pretty clear, and they are facts. It's not hopes and dreams. Is this vaccine going to be ready? Is this treatment going to be ready? The facts are what they are right now. 20% unemployment in the US, GDP falling almost 5% in a quarter, consumer sentiment falling by record amounts. We shouldn't be surprised to see share prices fall again in the nearer term. Thank you very much. Hope you enjoyed the presentation.